Good morning. I'm Randy Barkley, and that's Jeremiah. And we are at different locations. And so Jeremiah is sharing a part of his vacation. So if you hear noises in the back, it's probably his children and other factors. You can kind of see from his background, he's kind of in the open field right now. But anyway, he traveled all day yesterday to get up to a point where he's visiting family. I'm still stuck here in the office, though, because somebody has to hold down the fort, something like that.
And you
So,
do a great job of holding it down for us.
right.
Yeah. As everyone knows, we're both certified financial planners, and I'm also a California licensed attorney. And each week we talk about things that hopefully make your life better. So this week we're going to jump into some, I think, interesting topics.
Yeah, so last week, the market had a phenomenal rally. And of course, the pundits came out on Monday, Jeremiah, and the first thing they said is this just a bear market rally.
Yeah.
And so a bear market rally just means the markets have a tendency to go up, but then it's just on their way down, right?
Yeah. And some of part of the things I talk to people about is you got to stay invested because some of the best days in the market are in the middle of a downward.
Right.
Even though it's going out, trying to time it and just skip out on these bad moments is very difficult because some of those bad moments include some great days. So if it's a bear market rally, in essence, the pundits are saying it's going to go up, it's going to go back down. We're still in downward slide.
Yeah, and again, I looked at this article, and I think most of you can kind of see this. This is a Wall Street article that came out on, this came out on last Thursday, and it says the Hail Mary for investors. So in essence, the author of this particular article is saying, okay, you got a reprieve, so let's just sell out.
Right.
It's up a little bit. But then Monday hit, and the market continues. Now, we had some volatility with Pelosi going to Taiwan, but then the market started to recover the next day. So again, the valuations that we look at, are we still headed downward? Is there still going to be a downward leg from here? And nobody can tell you yes or no, right?
Nobody knows. And when we look at the market, one of the things that we talk a lot about is, what does it look like in 10 years? What does it look like in 3 years? What does it look like now? And the hard thing, and a lot of people are seeing this, is the market right now has turmoil, it has uncertainty, we're getting conflicting ideas. You look at some of the bond rates for 10 years from now, it looks like smooth sailing. And I wonder how much of that is people either sticking to their guns and saying, yep, this is a long-term investing, we're going to be fine, and not impacting the future rates, or is it people just assuming we'll be fine or we won't be fine, but I can't think of that right now. I just have to focus on this. It's a real interesting market seeing the level of volatility that we have today as compared to what they see for interest rates and for a number of other things down the road.
And so active management, you can get active management where they're constantly sorting stocks and are kind of looking at the holdings based upon certain factors like PE ratios and profitability and outside interest rates and inflation such as that. But bottom line is that active management for particularly the newer investor and the younger investor, and if you've got at least 5 years or more in your investment, in other words, the use of, and particularly retirement funds, passive pretty much beats out active.
Yeah.
We have to really admit that because the numbers show that, right?
I think it's an interesting part of this industry of saying that we manage people's money for them, and there's an argument to be made that all the best minds, all the best thoughts coming together don't make any difference.
Right.
You could have just bought an index, the S&P 500 or Vanguard makes a number of great indices that you just buy that, you hold it as a passive fund, there's no adjustments, there's no changes, and just let it go for 10 years versus someone who is every day or every month pulling, changing, adjusting, trying to be strategic. And the argument, like you said, is does this make a difference over, sorry, I think you hear a rooster in the background, but you might hear that here. But does this make a difference over time? And the statistics say generally that it doesn't.
Yeah, and I think the key here is that we separate ourselves, what we do, active versus tactical. I want to go in, I want to fall in the camp of being a rational optimist. I think that overall the market will heal, it will make mistakes, it'll bump, but over the long haul, the economy will continue to grow. And it's shown that over literally hundreds of years that it'll do that. But in the meantime, tactical aspect means that you're taking a look at valuations and you're looking at macroeconomics and you're rebalancing your portfolio. You aren't necessarily pulling out individual stocks, but particularly for the investor that's got 5 to 10 years before the use of that money. But being tactical is really important. I think it helps to prevent those really major downturns, like what happened back in 2000, what happened in 2008. Being tactical really helped to limit the loss, and then you can pick back up again when the market kind of hits the bottom and pull out again.
And the hard part, I think that the part we can be really candid about is the difference between being tactical and just trying to time the market. And
Right.
there's some overlap, right? To say if we see everything's going down, let's pull out for a season. And the same thing can be said for someone who's just trying to time the market, saying, oh, we're in a downturn, out we go, and jump back in. And the line there is probably blurry to some extent to say at what point are we just seeing the writing on the wall and making strategic choices? At what point are we just trying to time this? Because we have no interest in trying to time the market. We're not
Right.
trying to just say here's a week to be in, here's a week to be out. And maybe it's just the discipline that goes with that, to say when we adjust a portfolio, we might adjust it, 10, 20% of it. We're not wholesale in, wholesale out. And part of it too is where we see it, we're not trying to be the first mover to say, oh, we're projecting this, but rather to say, this is the trend we see it continuing, so let's respond accordingly. But I think there's probably fair criticism for people who are outside this industry to look in and say, what are you really doing? What value are you adding? Should I just buy a Vanguard ETF and forget about it? And for some investors, the answer is yes. They don't need the sophistication. A lot of the folks that we work with have some real tax implications they need to be mindful of. And that
Right.
tactical is not just tactical for the market, it's also tactical for their life and their income structure to make sure that how taxes overlay with this investment.
Yeah, and I mean, again, not only taxes, but also in the realm that you deal with a lot of our clients, and that's in estate planning. It's what I call that wealth management. So we work with a tax standpoint, but you come right alongside of clients, making sure their estate is established in such a way that if there is a disability or a death or whatever, that that they're that they're not going to be hit or blindsided by some event that's going to change the economic outcome, right?
Yeah. Yeah, to let's say to miss the big ones, but to have a safety net in place.
Right.
If there's a massive, hit to the stock market, do they have bonds or other investments that will keep them up? If they're having a high exposure to the market, do they have other assets that will allow them to mitigate that? I mean, I think being holistic is so important to where it's not just, this one pool of assets, this is everything, get it invested, but to say, what is their cash savings? What is their real estate? What are their other holdings? What are their pensions or their future income?
Right.
Take that whole picture, and with that, I think it's a lot easier to paint an aspect of it that says this will be your investment account. But put everything in your whole life into one account, it becomes very risky. And if we were holding an account like that, we would, within that account, diversify and take out the risk just because it needs to be. Whereas when you have people
Yeah.
who have good other assets, they could have a higher risk investment account.
Yeah, for example, if I mean what I call the high conviction holdings, like for example, if you bought real estate in right after the downturn in 2008, and you're holding on to something that has phenomenal gain, but yet to sell it, the taxes would be devastating. You'd end up not only paying the capital gains, but you'd have recapture of depreciation. It's pretty devastating. So you're looking at exchanges. But once you're in that, if your motivation is to minimize the taxes that you pay, you're kind of stuck in real estate. You're going to be doing it until somebody dies, until there's a step-up basis. Now with stocks, it's kind of the same way, but stocks are typically you don't have these high convictions into one or two stocks. Every once in a while I'll talk to somebody, they're loaded up on, Apple or Microsoft or whatever, and it makes up the vast majority of their portfolio, and they've got a massive amount of capital gains. I talked about, we've talked about that with Berkshire Hathaway. I've had some clients where they started investing with Warren Buffett, 20, 30 years ago. Well, those stock holdings now, remember the stock prices on Berkshire Hathaway, we're talking hundreds of thousands of dollars. A lot of those stocks, if you sell them, you can't mitigate that capital gains. That's why we like diversification, and we like to have, kind of that no more than a certain percentage in particular holdings. It makes it much more flexible and tax efficient, right?
Yeah. Well, and even as easy that part of tactical, one of the things that we do is a lot of the portfolios that we manage in-house, we rebalance them every quarter.
Right.
Meaning that if you had, say, a section of Apple and Apple went up really well, rather than just holding that, we would actually sell off some of that because it's skewed. If you had 5% Apple, it's now become 8% Apple. We would sell off some of that to bring it back down to 5%. And that helps you sell high. On the flip side, if say Microsoft had gone down, we would buy more Microsoft to get it into that percentage that we want it to be. And with that, you're buying low, selling high. It's a natural turnover of the portfolio. But what that prevents is, just like you said, 20 years from now, rather than having one holding that is now grown and it becomes awkward and tax inefficient to ever sell it, you can locked in. You have an ability to say, well, I only have 5% Apple. Over the years, I've bought and sold lots of Apple, but now I only have 5%, which I've always wanted to have 5%, versus allowing that to grow and grow and grow and become 15% of your portfolio, locking you in an awkward position. If you see something in the world that you want to exit Apple, they have a practice or some reason that you want to exit from Apple, and you've held it for 15 years, you've got a lot of capital gains you have to deal with. And so part of that tactile aspect is rotating the portfolio in a way that keeps it healthy and keeps it balanced.
Right.
Years ago, there was a concern about churning, is that brokers would trade these accounts and they would generate fees every time they did it. And so they shouldn't have been doing that. They shouldn't be rotating things. Whereas now in the environment we're at, trading costs have gone to zero.
And that's really important to emphasize, because as fiduciaries, we don't receive any commission. We receive zero compensation from the buys and sells, the transactional aspects of a portfolio. We truly are looking at what is best for that client.
Yeah.
So if we were to sell something and to buy something else and do that rapidly, let's say within a 30-day period, it does not increase our compensation one iota. And that's really important for the client, for our clients to know.
Yeah, and it's important from my perspective to be able to do something like this, to say, years ago this wasn't an option to keep a portfolio this healthy. Whereas now we have the ability to constantly be rebalancing and keeping things up. And we don't do it weekly, we don't do it monthly. We've decided that quarterly is the optimum outcome for us. And we may change that in the future. But I like the idea of being able to keep a portfolio nimble and healthy and balanced from an academic standpoint of where we think it should be. And we believe that produces better outcomes. But even if the stock outcomes were the same, that portfolio you have 15 years from now does not have a buildup of capital gains, does not have a buildup to where you can't get out of it without significant tax consequences.
Yeah, I mean, again, people that have large holdings, and again, the probably the thing that's the emphasis there is real estate holdings. So they have rental properties they've acquired. We're not saying in any way, shape, or form that that's a bad thing. What we're saying is that because of such a high conviction, the value of that in relationship to maybe total assets is not as maneuverable. It's not as adjusting. So if we're going down through another downturn and real estate is going to be affected negatively, they're not as easy to adjust because of all the built-in values, the tax aspects of it and everything else, the capital gains, as you would be if you had 100 stocks. And you could make changes within that portfolio.
You adjusted, yeah. So when you kind of come back to this larger conversation, passive investing versus active investing, it's a false choice. It doesn't have to be one or the other. I think what we take is a tactical investing is what we call it. But to say, passive investing, just buying a fund that's well diversified, letting it go for 20 years is not a bad choice. That is a really great option for a lot of people, but knowing you're going to build up a lot of gains there. And if it's a Roth IRA, great. We don't mind the gains, But if it's your regular taxable cash account, there's some concerns with that. And so not that you have to go active in the sense of someone trading for you on a daily basis, but rather say someone that's tactical, that's going to keep the portfolio balanced is really a healthy way to go.
Yeah.
Well, if you missed any part of this episode and want to hear more of it, you can find it on our website, retirementunlimited.com, or you can find it on YouTube. Just search for Retirement Unlimited and you find a bunch of our shows. And if you have a comment or just an item you'd like us to discuss on a future episode, you can go to our website and click on the contact button. It's www.retirementunlimited.com. Leave us a note and we'll make sure we talk about your thoughts on a future episode.